certainly a lot to talk about. We're still in this world war against the virus. It started over a year ago. And like most world wars, there's more than one front. There's three fronts. There's the health front, there's the financial front, and the economic front. Clearly, the most important front is the health front, and we've made a tremendous amount of progress in that regard. Let me share some charts with you that will allow us to breeze through some of these concepts more quickly. This is the chart on new positive results in hospital patients for the United States. And as you can see, we had three waves, and we've made a lot of progress of late. The third wave was the worst in terms of the results in the hospital patients. The first wave, however, led to the lockdowns, and the lockdowns in turn led to a terrible recession, that only lasted 2 months, March and April. And we also had a terrible financial credit crunch that only lasted a few weeks as well, because the Fed came in on March 23rd of last year and provided an enormous amount of liquidity and supported the corporate bond market. And that was really the beginning of the end of the financial crisis on the financial front. And we've made a great deal of progress with the stock market going on to make new record highs, with credit spreads, credit quality spreads in the bond market narrowing back to historical lows, with corporations being able to refinance a lot of their debt at record low interest rates. So the Fed clearly made a huge difference in coming in on March 23rd. That was the day that the Fed adopted QE forever, kind of an open-ended, unlimited commitment to buy treasuries and mortgage-backed securities, and also to back up the corporate bond market. It turned out that the announcement effect was so impressive that the Fed really didn't have to do much in the way of actually buying corporate bonds. The corporate bond market opened up very quickly. And so we went from a mad dash for cash in February and early March to suddenly a flood of liquidity, and suddenly a mad dash to rebalance out of cash and into stocks, and even into and also into corporate bonds. Then during the first lockdown, it worked. The idea of the lockdown was to keep us from breathing on one another and spreading the virus. And the idea was to level or to flatline the curve of hospitalizations, and it worked. But then I guess the pain of the lockdowns, the economic consequences were so dreadful that we did start to see the withdrawal of these lockdown restrictions. And that led to a second wave and then to a third wave. But by late last year, the drug industry, Pfizer, Moderna, J&J, in record time came up with vaccines that have been very effective. It took a little while to distribute, but all in all, we've made a lot of progress on distribution. And so on the health front, things are going extremely well. Concerns that there might be another wave, I think, have dissipated because the vaccines seem to work so well, even against some of these mutations that we've seen coming out of places like Brazil and India. I've been monitoring, everybody's got their favorite weekly indicators for watching the economic front. And on the economic front, I've been monitoring gasoline usage. And you can see the purple line is what gasoline usage was doing last year. And you can see the extent to which the lockdowns really just did a number on the economy. We've never had a lockdown like this of any sort, really. I made a comparison back then to the Twilight Zone. I'm a big fan of movies and vintage TV classic series. And the Twilight Zone, I went back and researched it. It turned out that the first episode of the Twilight Zone in the late 50s was called Where Is Everybody? And that's exactly what it felt like in March and April. Everything was closed. So while the lockdowns worked in reducing the spread of the virus, I think we all got cabin fever. And one of the ways to relieve cabin fever is to go out and do some shopping. And so as the withdrawals as we withdrew the restrictions on mobility and going out and stores did start to open up and you can actually go shopping, we did see that people started driving again and doing that. So if you look very carefully, right there in mid-May, there I am at the gasoline station pumping gas in Long Island into my car after staying home for 2 months. Where are we now? The red line shows that we've made a lot of progress and we're almost back to where we were in 2019 in terms of gasoline usage. And maybe the reason we're just not there or higher is simply because a lot of us are still working from home. But we also know that people are buying used cars like crazy, so they need gasoline. And again, I think we can anticipate that series will show that we're back to normal, at least in gasoline usage, by later this year. So we've had this extraordinary, unprecedented business cycle with a horrible 2-month recession, March and April. All the major economic indicators bottomed in April. And real GDP has had this extraordinary recovery from the April bottom. Well, actually, it was the first, as you can see in the table here, it was the first and second quarters of last year that real GDP took a dive. But then it rebounded dramatically in the third quarter, continued to rebound in the fourth and the first quarter of this year. And so during the second quarter right now, which is likely to be up something like 9% at an annual rate, we are back to where real GDP was at this before this whole thing started. So just an extraordinarily quick recovery. And granted, that's not the case in the labor market. All kinds of things going there. Some people may be having hesitations about going back to work because of the concerns about the virus. Some may be having problems with childcare. Some may be taking advantage of the very generous government benefits. We clearly have labor shortages. Everybody seems to have jobs available, but we're not filling those jobs. And there's about as many jobs, over 8 million open jobs, as there are unemployed people. So some of it may also be skills mismatch. Some of it may be geographic mismatch. But what is really extraordinary is that here we are now in the expansion phase of the business cycle, right? You go for the recovery is when you recover back to where you started, and the expansion is when you've achieved that, and now you're going into record high territory. So the expansion phase has started, and never have we seen a boom at the beginning of an expansion phase, but that's exactly what we have. And that's a combination of people continuing to try to deal with their cabin fever by going shopping, and to the extent they've bought everything they want in the goods markets, now as we're able to travel more, I think you're going to see the services industry boom, hotels, motels, sports, resorts, travel abroad, airlines, all of that is making a huge comeback. And we've got two of our key policymakers, namely Janet Yellen and Jerome Powell, saying that they want to keep their foot on the accelerator. So it's not just cabin fever, it's also the extraordinary amount of fiscal and monetary policy that started back during what I call MMT week. March 23rd was the beginning of that week. It was a Monday. Modern monetary theory was basically implemented on Monday, March 23rd. And then on March 27th, Congress and the president signed the CARES Act. And that was the first CARES Act. And we've had a couple since then that have provided tremendous amount of fiscal stimulus to the economy. So our key policymakers have told us they intend to continue to step on the accelerator, and they want to get to broad-based and inclusive maximum employment. That's what they call it. And to do that, they want another round of fiscal stimulus. And meanwhile, the Fed continues to buy $120 billion per month in treasuries and mortgage-backed securities. You can see the tremendous impact this has had on the economy. Never before have we seen this blue line, which is government social benefits in personal income, go straight up like this, not even back in the great financial crisis. And then we've had 3 of these rounds of checks and generous government benefits for the unemployed. And so this was the first, this was the second, and here's the third, which is even greater than the first 2. And the money came in so quick that initially it went into personal saving. And as you can see, there's still a tremendous amount in personal saving. And yet they want to continue this to provide more and more liquidity. So here in this recession, never have we seen such a quick recovery back to all-time record highs in consumption of goods. Services has been constrained, but as I said, we've made so much progress on the health front that we're now pretty much going to where we had started, getting rid of masks, telling people they don't have to necessarily wear masks, opening up all kinds of opportunities in the services area that were not open before. So this is going to be a very stimulative event, with even without all the stimulus provided by the Fed and by the Treasury. We've also seen tremendous stimulus coming in the housing market. And as you can see, this is the sum of new plus existing homes. It seems to be having a problem now. Demand has been boosted to such an extent across all different sectors of the economy, including housing, that we're seeing shortages. And I think this is some. I think,
45-minute delay turned into a 10-minute delay. So we all have to guys if everybody's not on the
somebody needs to be put on mute. Somebody needs to be put on mute. Okay. So the shortages are a problem, and start to raise the real issue that we've seen here in April with inflation really starting to heat up. So that's the big issue, obviously, today is inflation transitory, or is it here to stay for a while? Obviously makes a huge difference in a lot of our investment and business planning. I'm open-minded on the possibility that it's going to be here for a while, but for now, I'm siding with the Fed that it's probably, to a large extent, going to be transitory. Though the Fed, I think, has taken too much of a one-sided bet in that regard, and that they've said that, look, a lot of the inflation we've seen and we're going to see the next couple of months is base effect. In other words, airline fares, motels, hotels, gasoline, a lot of these prices were depressed in March, April, May, and June. And so when you do year-over-year comparisons, you're obviously going to see a pickup in inflation. But there's so many variables that are showing that inflation is a here and now problem. It's not just a matter of a year-over-year comparison. We know that producer prices are going up on a month-over-month basis. We know the commodity prices have been soaring. We know that the prices paid and received indexes are going up, and those are diffusion indexes that are month over month. So given all that, given the stimulus, why would it just be a relatively short burst of inflation? Well, I'm a big believer that a lot of businesses have come to realize that labor just simply isn't available. That even before the pandemic, we had labor shortages. And now I think there's a recognition that this is a permanent situation. We just forgot to have kids along the way here. Fertility rates have declined in the United States, and the working age population is basically growing around 0.5%. Keep in mind, real GDP growth is productivity growth plus labor force growth. So I think productivity growth is in the early stages of making a big comeback, and I think that's based on technology. If you look at technology as a percent of total capital spending, it's over 50% of total capital spending in current dollars. It's up dramatically over the past several decades, obviously. And by the way, this is an understatement because I'm only including IT equipment, software, and R&D spending. I'm not including things like industrial machinery, which we know is a lot of high-tech hardware and software that's just dedicated for a certain function. I happen to think that the trucking industry is high-tech. The truck is the app, and There's a logistics software running on a cloud somewhere that's running that app. Railroads have become basically devices that are run on apps. So I think we're making tremendous progress in technology. The technology revolution started in the IT revolution started in the early 90s. It was kind of clunky, big PCs, big laptops. Software had to be installed on individual machines. The cloud revolutionized that, all of that. And of course, there have been lots of other technological innovations that we're only scratching the surface, including 5G telecommunications, 3D manufacturing, augmented reality. The technology revolution has evolved to the point that I think it has the potential to increase the physical and mental productivity of the labor force. And we're seeing a lot of announcements from companies saying that they intend to pay their workers more. But to do that, it only makes sense if you increase their productivity, and you're only going to do that with technology. So again,
Ed, can I just jump in here 1 second?
Yeah.
And I hope that you can hear me better. You hear me clearly?
Much better. Perfect.
Okay, great. That's because I'm speaking right next to the laptop. Anyway, so my questions are, is energy a big factor in inflation?
Yeah, I mean, energy always is an issue. And it was an issue in the 1970s. We had two energy shocks. I think there are a lot of concerns that the 1970s are about to make a comeback because we do have two energy shocks back then. We had food shocks. This time around, we've got a lot of commodity prices going up, including grain prices. But back in the 70s, we had cost of living adjustments in labor union contracts, and that just doesn't exist anymore. Some people are arguing that the government, what the government's really trying to do by paying very generous unemployment benefits is push up the minimum wage, and maybe that in some ways is comparable to what happened in the 70s with cost of living adjustments. But the most important cost for most businesses of doing business is labor costs. Energy, food, they're not that relevant to running a business. I mean, copper matters, lumber matters, but in terms of the bulk of businesses, it's labor costs. And labor costs is wages and benefits offset by productivity. And what happened in the 70s is wages and benefits soared, partly because of the cost of living adjustment phenomenon. All those supply shocks went into wages. And then look at this chart on figure 8, and you can see the productivity growth collapsed. This is the 5-year percent change at an annual rate in productivity. And we went from a productivity boom in the 60s to a complete and total bust by the end of the 80s. And so that was a major contributor to inflation. Now, to a certain extent, that was because the labor force was growing rapidly. Here I am, you can see me on the red line. This is the year-over-year percent change in the civilian labor force. Again, a 5-year percent change at an annual rate. Here I am entering the labor market. And then ever since, we've seen the labor force growth decline to basically 0.5%. I think companies have no choice but to increase productivity. And we're already seeing productivity making a comeback from 0.6%. That's on a 5-year percent change basis. So that's how pathetic it was for the previous 5 years. And now we're up to 1.9%. I think the pandemic accelerated the pace at which technological innovations are being incorporated into business models to boost productivity. So
Ed, real quickly, I just want to jump in again. Yeah. With respect to the labor shortage, are we talking about, is college educated labor, high tech labor, or is this all labor?
Yeah, well, with all due my respect to my 5 college educated kids, there's too many kids coming out of school with BAs and not enough going to trade schools or learning trades and becoming apprentices and things like that. There is definitely a shortage of blue collar workers, and I don't think there's a real shortage of college educated people. There's certainly plenty of them.
Right. I think that you mentioned trucking before, and I think there's an upcoming shortage of truck drivers. Is that correct?
That's correct. Yeah. Well, I mean, we got that already. But productivity has increased quite dramatically in the trucking industry, as it has in the railroad industry. But we are seeing a solution being developed, which is driverless cars and driverless trucks and so on. So I think the productivity cycle this time around is going to go back to 3 to 4%. And again, real GDP is productivity growth plus labor force growth. And if labor force growth is stuck around 0.5%, the only real source of growth is going to be productivity. And that's a wonderful thing, because productivity does justify wages going up relative to prices. You do get real wage gains when productivity is going. There's this urban legend out there, there's this myth that wages have stagnated relative to inflation for decades. The reality is the real wage adjusted for inflation has been going up 1.2% per year since 1995. And so we have seen that productivity has allowed wages, real incomes to rise, and that's the source of prosperity. Marty, what do I have left, and what do you want to do?
Hold on a second.
What's that?
You got about 5 minutes, Ed.
Okay, well, let me conclude with the implications for the bond market and the stock market. People ask me, well, are we overdue for a correction? Are we going to have a bear market? History shows that bear markets and stocks are caused by credit crunches, and which lead to recessions. Credit crunches, in turn, tend to be caused by this. When the yield curve is ascending, the market, you usually see bond yields rising faster than short-term rates. That's kind of early recovery, early expansion periods. The yield curve starts to narrow when the market starts to sense that the Fed is raising interest rates too rapidly, and that something's going to break. And that's when short-term rates start rising faster than long-term rates. And right now we're in the early phases of this business cycle. So the yield curve is ascending. I think it's going to go to 300 to 400 basis points. I think the bond yield is going to go to 2% by year end and 2.5% to 3% next year. I'm not telling you we're not going to have, I'm not telling you inflation is going to go back to under 2%. I think it's going to be 3 to 4% for the next several months, and then settle down to maybe 2.5%. And having the bond yield go back to 2.5%, 3% is where it was before the pandemic. So I don't think that's exactly anything to be particularly concerned about. We are in an inflationary boom right now, which is really good for corporate earnings, and corporate earnings should be up significantly this year and continue to be rise at a double-digit rate next year. I've got the S&P 500 going to 4,800 by the end of next year with that kind of background on earnings. Marty, anything you want me to wrap up on or mention beside what you've asked me?
No, I think it's a good job so far, Ed. Listen, I want to thank you very much. So I'm right now I'm speaking from my laptop. I'm waiting for my guys to fix up the projections here, audiovisual. So Mark, you're able to speak? I'm going to open up things for your group, talking about manager allocation.
Well, I am here, Marty. So thank you for that handoff. Ed, great job. Really appreciated the insights. I learned a bit from you this morning. Very insightful, and you didn't give us any prediction on the crypto market.
A week ago, I wrote a piece saying that aren't they going to ban them? In other words, our government's going to, after what happened with Colonial Pipeline, where they had to pay $5 million in Bitcoin, I figured the government's got to get the message that you got to put an end to cryptocurrencies. And so I wrote that up and I put it in LinkedIn last night, and the Bitcoin took a dive. So, I mean, Bitcoin to me is digital tulips. It's a financial virus that spreads and then it doesn't, or it's .coms. It makes no sense to me.